Okay, so this is a FAC 3704 2019 October November exam. So we're going to read, so we're doing question 3, but we're not going to do the entire question 3. We're going to read the scenario, and then we're going to attempt part A of the scenario, which is the intercompany transactions. So we just want to read the scenario so we get a feel of the scenario, and then we will attempt the specific aspect of the question. So let's get going.
Okay.
So let's say Buck Ltd was established in 1995 and is a manufacturer and distributor of medication in Gauteng. The following is an extract from the annual financial statements of Buck Ltd and its related group investment companies for the year ended 31 December 2018. Okay, so there you can see they're giving us the extract of the financial statements for the 31 December 2018. So that's most likely the current financial year. So therefore, the current financial year is 1 January 2018 to 31 December 2018. Buck Ltd Group, statement of profit or loss and other comprehensive income for the year ended 31 December 2018. We have revenue, we have cost of sales, we have gross profit. Then we have other income, other expenses, we have profit before tax, we have income taxes, and then we have profit for the year.
That's you.
Then we have the profit that is attributable to the owners of the parent and then to non-controlling interest. Then they give us a statement of changes in equity for the current financial year, 1 January 2018. Then we have changes in equity, profit for the year, dividends paid, and then we have balance at 31 December 2018. What we currently have is retained earnings, non-controlling interest, and that is for Buck Ltd. Then we have Nanny Ltd and Kid Ltd. That is the retained earnings. Okay.
Okay.
Then they give us a statement of financial position. We have property, plant, and equipment. So Buck has an investment in Nanny. Buck also have the investment in Kid. So that is a horizontal group because the parent have a direct investment in both entities. Then we have current assets, cash and cash equivalents, inventory, trade and other receivables. Then we have the equity, the share capital, retained earnings, non-controlling interest. And then we have deferred tax liability, and we have trade and other payables. So at this point in time, we don't know whether we have a subsidiary, whether we have associates, we don't know. So we'll have to read further, and from there we'll be able to determine what do we have. So number one is Nanny Ltd was incorporated in 2016 and has a huge distribution network of pharmacies in South Africa. Nanny Ltd's head office is in Polokwane, South Africa. Okay, so Nanny was incorporated in 2016. On 31 December 2018, Buck Ltd acquired 350,000 of the ordinary shares of Nanny Ltd for 200,000 Rand. Since this date, Buck Ltd exercised significant influence over the financial and operating decisions of Nanny Ltd. So when we have significant influence, we have an associate. So remember, we have Buck has significant influence over Nanny. So therefore, Buck has an associate. So what Buck will have to do? Buck will have to equity account Nanny. So remember, equity accounting means you only bring your portion of the net assets and your portion of the investment. That's all. You don't bring in 100% of the assets and liabilities, income and expenses. So very important to take note of that. Then they say on the acquisition date, all the assets and liabilities of Nanny were considered to be fairly valued. The strategic reason for the purchase of the shares was to take advantage of Nanny Ltd's distribution network to distribute Buck's latest product range, product X2341, ointment for measles. The published market price for the investment in Nanny Ltd was 245 on 31 December 2018. Okay, so remember, we don't worry about market values. It may play a role depending on how we account for it in our separate books, but from a group point of view, we are only interested in costs because we use equity accounting. Number two, on 1 June 2015, Buck Ltd acquired 75,000 of the issued ordinary shares of KID Ltd for 102,000 Rand. In terms of a contractual arrangement with other operators, Buck Ltd exercised joint control over the economic activities of KID Ltd. So there we have a contractual arrangement that gives us joint control. When you have a contractual arrangement that gives you joint control, that means you have a joint arrangement. When you have a joint arrangement, we will have to determine whether we have a joint operation or a joint venture, because that will tell us how we will have to account for the item. So they say the arrangement was correctly classified as a joint venture in terms of IFRS 11. On the acquisition date, all the assets and liabilities were considered to be fairly valued. On 1 June 2015, the retained earnings of KID amounted to 105. Goodwill amounting to 700 Rand arose on the acquisition of KID Ltd on 1 June 2015. Okay, so both transactions is an so for Nanny, we exercise significant influence. So
Mm-hmm.
because we have an associate, so the accounting treatment is equity accounting. For KID, we have a contractual arrangement that gives us joint control. Because we have a joint control, that means we have a joint arrangement. When you have a joint arrangement, you have to decide how you're going to classify the joint arrangement as a joint operation or a joint venture. So they're telling us we have a joint venture. Because we have a joint venture, we will also equity account. So an associate as well as a joint venture is accounted for in exactly the same way. Both are accounted for using equity accounting. Okay, so you're happy with that.
Mm-hmm. Yes.
So we're not going to deal with that today. We're going to deal with the intergroup transactions. But knowing what type of entity you have, what's the nature of the investment, that will dictate how we do how we do the intergroup transactions. So let's have a look. So say during the current year, Nanny Ltd purchased product X2341 from Buck Ltd for 250,000 Rand. Buck sold this product to Nanny at a profit markup of 15% on the cost price. On 31 December 2018, Nanny had inventory of X2341 that was purchased from Buck Ltd on hand amounting to 20,000 Rand. Okay.
Yes.
So there's only something that we have in the current year. When you have an intergroup inventory transaction, there are three, but in this case there will be two journal entries. If you made sales from the prior year already, then you will have three journal entries. But if there's only something in the current year, then you will have two journal entries. Journal entry number one, it is to remove the intercompany sale. Journal entry number two is to eliminate the unrealized profit, because you can see that Buck is charging a 15% markup, right? So they're charging a 15% markup. So there's an unrealized profit. So we'll have to eliminate that 15% unrealized profit. Okay, so just take note. So
Okay.
when there's an intercompany inventory transaction, there will either be three journal entries or two. When you only have something from the current year, you will have two journal entries, eliminating the sale and eliminating the unrealized profit included in the inventory on hand. Okay, let's go to number four. From 1 June 2015,
And
Buck,
then can I ask,
yes,
then what would be the third journal then?
we're going to deal with it here now in number
Oh,
four.
okay.
Um, from 1 June 2015, Buck Ltd purchased inventory from KID Ltd. KID Ltd sold the inventory at a profit margin of 20% on selling price. The total sales amounting to 310 in the 2017 financial year and 350 in the 2018 financial year. Inventory purchase from Kid that was still on hand at the end of at year end was as follows: 31 December 2017, 31 December 2018. So here you can see in point number three, we only had inventory on hand in the current year. But in point number four, we have inventory on hand in the current year as well as the prior year. So now we know there's an unrealized profit included in the prior year. Therefore, we will have three journal entries where we have to take care of the prior year unrealized profit. But we'll deal with that when we do the question now. So now we have other information. So Buck measures investments in associate joint ventures at cost price. Buck Ltd. Buck Ltd. Group accounts for investments in associate joint ventures using the equity method. They have no choice. The share capital of the companies in the group remain unchanged. It will always be the case for our purposes. The SA normal tax rate remained unchanged at 28% since 1 June 2015. Okay, so that's fine. So what we're going to do, today we're going to do we're going to prepare the pro forma journal entries to account for the intergroup transactions of inventory. Okay, so we're going to deal with that, and then we will so that's what we'll focus on for today. So I'm going to open up Excel and then we will go through it. Okay. Can you see Excel?
Yes, I can.
Okay. So when you're dealing with the intercompany sale of inventory, it's basically going to do, we will have three journal entries, okay? So the three journal entries for intercompany sale of inventory, so intercompany sale of inventory. So be three journal entries. Number one, um, eliminating the
Really?
eliminating the intercompany sale, then eliminating the unrealized profit, unrealized profit in current year closing inventory, okay, and then what we will have to do is basically recognize the unrealized profit in prior year closing inventory. So you only do journal entry number 3 if you are dealing with, if you have a prior year inventory balance on hand that was intercompany. So we saw we have it. So just take note of that. So in only in the second one, in the first one, we didn't have it.
Oh, okay.
Okay. So now let's have a look. So let's have a look at how we will deal with this journal entry. We're going to deal with Nanny first, and then we will deal with Buck. So I'm going to do it. What I'm first going to do, how you do it for a group, for a subsidiary, right? Then I'll show you
Okay.
the difference that we will do it if based on this when we have an associate. So we know that if you look at the scenario in for the nanny and buck situation, what is important to take note, buck is selling to nanny. So the parent is selling to the associate. So we call that a downstream transaction. Okay. So the parent is selling to the subsidiary, to the associate. As a result, the parent is making the profit. So the profit is included in the parent. Okay, so that's very important to understand. Now, if this was a subsidiary, let's just assume this was a subsidiary relationship. So Buck is the parent, Nanny is the subsidiary. The journal entry would look as follows. So journal entry number one, to eliminate the sale. So remember, included in sales is an intercompany sale. We don't want that sale. So what we'll have to do, we'll have to remove the sale. We have to decrease sales. Sales decrease on the debit side. So we'll have sales, which is included in P&L. If we just do this, debit, credit. So remember, that's not the actual answer. I'm just doing this now as if it is a subsidiary. Then I'll
Yeah,
do
okay.
the answers just so you can see the difference. So if this was a parent subsidiary relationship, remember with a parent subsidiary relationship, we recognize 100% of the subsidiary's assets, liabilities, income, and expenses on a line by line basis. Therefore, when we have an intercompany transaction with a subsidiary, we must eliminate 100% of the intercompany sale. So therefore, the intercompany transaction, why? Because we're bringing on the subsidiary at 100%. So therefore, the full intercompany transaction would be considered intercompany, and the group does not want any intercompany transaction. So therefore, we remove 100% of an intercompany transaction that is between the parent and the subsidiary. So if this was a parent-subsidiary relationship, in the current financial year, um, the sale was 250,000 Rand. So we will have to decrease sales. We need to decrease sales. Sales increases on the credit side, so therefore sales decrease on the debit side. Remember, a decrease in sales decreases profit or loss. A decrease in profit or loss decreases equity. Equity decreases on the credit side. The other side of this transaction goes to cost of sales, also through P&L. So what would happen? We will bring it, we will decrease cost of sales. So remember, decreasing cost of sales is decreasing an expense. A decrease in an expense increases profit or loss. An increase in profit or loss increases equity. Equity increases on the credit side. That is why we will credit cost of sales. So that is what we will do. That is what we will do if this was a parent subsidiary relationship. So I'm going to highlight this in orange, which is not the actual answer. Okay. So this was the parent
Mm-hmm.
subsidiary relationship. That is what the journal entry would look like, eliminating the intercompany sale. So you debit sales and you credit cost of sales. What do we notice? That there's a decrease to profit or loss of 250. There's an increase in profit or loss of 250. So therefore, the impact on profit or loss is zero. All we are doing is we're decreasing cost of sales and we are decreasing sales. So the net impact on gross profit and the net impact on profit is zero. So there will be no, there will be no deferred tax implication. Now let's deal with this from an associate, and the same principle would apply for a joint venture because both an associate and a joint venture, we apply equity accounting. So now let's do the actual answer. What you would have to understand over here now, we would have to eliminate, we're going to have to eliminate sales and cost of sales. We're still going to eliminate sales and cost of sales. But this time, we're not going to eliminate 100%, okay? We're only going to eliminate the intercompany portion. The intercompany portion is our percentage of the associate. So the only portion we eliminate is the intercompany portion. What is that portion? The um, the portion relating to um, our portion of the associate. Now we need to work out what is our percentage. Our percentage we acquired, where was that now? I think we acquired 350,000 shares out of 1 million shares. So therefore we have a 35% interest. So when it comes to a subsidiary, 100% of the subsidiary is considered in the company. Why? Because we bring on the full 100% of the subsidiary. Whereas for an associate and a joint venture, the only portion that is considered in the company is our percentage. That's why we only bring on our percentage when we deal with an associate. So the only intercompany component is the 35%, because that is our percentage of the associate. So just take note. So we'll still have 250, but we're going to multiply this by 35%. How do we get 35%? 350,000 is divided by 1 million shares. Okay, so we're not going to eliminate the full 250. We only eliminate 35% of the 250. Why? That is the intercompany component. Are we happy with that?
Yes.
Okay. So now we'll ask ourselves for deferred tax. There will be no deferred tax implications. Why? The net impact on group profit is zero. You will only have deferred tax implications if there is a change in group profits. Here you can see group profits is decreasing by 85,700. Group profit is increasing by 85,700. So the change in group profits is zero. Because there's no change in group profits, there will be no deferred tax implication. So the green answer is the right answer for this particular question. Okay. Now we're going to do journal entry number 2. Remember, it's only 2 journal entries for the buck nanny relationship.
Okay.
You have a question? Did you say something? All right.
No, there's no question.
Oh, sorry, I thought I heard you say something. Now the second journal entry. Okay, so we just make this clear. This is the first journal entry. Now we're going to do the second journal entry. Once again, I'm going to follow the same approach. Deal with it with how you do it from a subsidiary point of view. Then we show you the actual answer that is from a parent associate situation. So in the second in the second journal entry, we need to eliminate an unrealized profit that is included in the closing inventory that's on hand. So included in inventory is 20,000 Rand. I think it was 20,000 Rand. We just check again.
Yes.
Yeah,
20,000.
it was 20,000 Rand that relates to that relates to the intercompany sale. So included in the associates total inventory balance on as at 31 December 2018 is 20,000 Rand that relates to the intercompany transaction. Included in a 20,000 Rand intercompany transaction is an unrealized profit of 15%. Remember, Buck is selling to Nanny, and Buck is making a profit margin of 15% on cost. Therefore, included in the 20,000 Rand is an unrealized profit of 15%. So because because Nanny did not yet sell it to an outside party, that 15% included in the 20,000 Rand is considered unrealized. The group does not want unrealized profit. The group does not want a profit that they made on themselves. They only want to show profits that they have made with those outside of the group, with third parties. So what would happen? We need to process a journal entry. Once again, I'm going to deal with this from a subsidiary point of view first. So Nanny's inventory is overstated. Nanny's inventory is too high. Why? Because included in the inventory is at 15%. The group don't want that 15%. So therefore, what we're going to have to do with inventory, we're going to have to decrease inventory. By decreasing inventory, you are decreasing an asset. Assets decrease on the credit side. So we're going to say credit inventory, credit inventory SFP. For every credit, there must be a debit. The debit goes against cost of sales. Cost of sales, and this is going to be P and L. Now remember, we're not going to eliminate the full 20,000 Rand. We're only going to eliminate the 15% included in that 20,000 Rand. So how do we do it? We will say it will be 20,000 Rand is the inventory on hand. We don't want to eliminate the full 20,000 Rand. We only want to eliminate the unrealized profit included in the 20,000 Rand. So what we're going to do, we're going to take out 15%, but now we're going to divide it by, if the profit is on cost price, it will be 115, 100 plus the markup. If it is on selling price, then we just say 15 over 100. But if it is on cost price, we say 15 over 115. So therefore, we eliminate the full unrealized profit, which is 20,000, 123, multiplied by 15, divided by 115. What's important to note, we eliminate the full 100%. Why? This example is the parent subsidiary relationship. Remember, we bring on 100% of the subsidiary. So therefore, the full intercompany unrealized profit is considered unrealized. Why? Because the full transaction is considered intercompany. 100% of the transaction is considered intercompany. Therefore, we remove 100% of the unrealized profit. As you can see over here, there's a change in profits. Why? A debit to cost of sales means you're increasing cost of sales. Cost of sales is an expense. Therefore, if you're increasing cost of sales, you're increasing an expense. An increase in an expense decreases profit. A decrease in profit decreases equity. Equity decreases on the debit side. So we are decreasing profit. There's no other transaction going through profit or loss. So therefore, profits is going down by 2,609 Rand. Therefore, because it's a change in profits, profit is decreasing, we will have a deferred tax implication. So the deferred tax implication will simply be, the deferred tax implication will simply be when it's deferred tax for the income statement, we will call it income tax. And this is P&L. And the balance sheet will simply be deferred tax SFP. So while we credit, while we have a credit to P&L, remember, because profit is going down, tax must go down. Because profit is going down, tax must go down. Tax is an expense. So if tax is going down, expenses is going down. When expenses is decreasing, profit goes up. When increase in profit increases equity, equity increases on the credit side. That is why we credit profit or loss. And the other side goes to deferred tax balance sheet. So it's simply going to be that amount times 28%. So there we go. This is now dealing with it from a subsidiary point of view. But now we know we need to deal with this from the actual one is to deal with it from an associate point of view. So let's deal it from an associate point of view. So what's important to note is to understand who made the sale and who has the inventory. Remember, the parent made the sale, so the profit is included in the parent. The associate has the inventory. Okay, so just take note. The associate have the inventory. So that's very, very important. So let's understand how we're going to deal with this. Remember, the associate have the inventory. Okay, so the associate's inventory is overstated. It is too high. Why? Included in the associate's inventory is an unrealized profit of that 15%. So therefore, the associate's inventory needs to decrease. Inventory is an asset. Assets decrease on the credit side. So we want to credit inventory. But remember now, with a subsidiary, we bring on 100% of the subsidiary's assets, liabilities, income, and expenses on a line by line basis. But with an associate, from an income statement point of view, we bring one line item on called share of associates' profits. From a balance sheet point of view, we don't bring on the assets and liabilities on a line by line basis, but we have one line item representing the associate's assets, which is investment in associate. So therefore, we want to decrease the associate's inventory. But we can't use the line item called inventory. Why not? Because we do not bring the associate on a line by line basis. So what represents the associate's balance sheet? It is investment in associate. So we will say investment in associate. So when you want to impact an associate's balance sheet, assets or liabilities, you can't bring on the asset. So we can't use the word inventory because we don't bring the inventory on from the associate. How do we bring the balance sheet on of the associate? Via the investment in associate line item. Very important. That is why I wanted to show you the difference in terms of how you do it from a subsidiary point of view versus an associate point of view. So we're still going to decrease inventory, but how are we decreasing inventory? Through investment in associate. So remember, included in the associate's inventory is 20,000 rands worth of inventory that is intercompany. Included in that 20,000 rand is an unrealized profit of 15%. The profit was 15 on cost, so therefore we divide by 115. But remember, from a subsidiary point of view, the full 100% is intercompany. Whereas from an associate point of view, only our percentage is intercompany. We only want to eliminate intercompany, so therefore we only eliminate our percentage, which is 35%. How do we get 35%? It is 350,000 shares over 1 million shares. So therefore we're going to credit 20,000, which is intercompany sale, intercompany inventory on hand, but we don't want to remove the full intercompany inventory. We only want to remove the unrealized profit. What is the unrealized profit? 15 divided by 115. But remember, we don't want to remove 100% of the unrealized profit because 100% does not represent intercompany. Only our portion represents intercompany. So therefore, we multiply by 35%. For every debit, there will be a credit. So it's going to be cost of sales. Why we affect cost of sales? Because remember, it is the parent that made the profit. So it's the parent's income statement we're going to impact. From a group perspective, we bring on the parent on a line-by-line basis, income and expenses, assets and liabilities. So when we want to adjust the profit, the group's numbers as a result of the parents' books, we can use the actual line item because we bring the parent on. We bring the parents' actual line items on. Same with the subsidiary. We bring the subsidiary's actual line items on. So just take note of that. Whereas with the associate, we want to adjust the associate's inventory. But we can't use the term inventory because we don't bring the associates inventory onto our books. We bring the associates balance sheet via investment in associate. We bring the associates income statement via share of associates profits. So just take note of that. Then we're going to have deferred tax. The deferred tax will be exactly the same. So for deferred tax, you can use as is. Okay, I'm not going to go into detail why. Just know you can use as is. Same rationale as to how I explained the deferred tax when we did the subsidiaries part. So just take note of that. So there we go. The green part is for this particular question. So that is nanny. Now we can do back. I mean, not back. What was the other one? Kid. Now we can do kid. So just take note, the orange is what you do if it was a parent subsidiary relationship. Okay. Once again, so I'm not going to do the parent subsidiary, the parent subsidiary part because it'll be the same. I'm just going to do it now for directly for the associate.
Okay.
So the only difference here is now in the nanny in the Buck nanny relationship, Buck sold to nanny. So Buck, the parent, made the profit. In this scenario, Kid is selling to Buck. So it is the associate selling to Kid. The associate selling to the parent. Therefore, Therefore, it is the associate that is making the profit. Okay, so the associate that's making the profit. So just be aware of that. So all we're going to be doing, so basically there's no need to have the intercompany elimination because the sale is not sitting with the associate. I mean, the sale not sitting with the parent because the journal entry would look like this: share of associates profits, share of associates profits. So therefore, in this scenario, when there is a sale from the associate to the parent, we won't have the first journal entry because the sale is not sitting in the parent, the sale is sitting in the associate. So to eliminate it, we're gonna say we're gonna do that, which is there's no point to do this. Okay, so therefore the intercompany sale for the current year was, I think, 350. I mean, let's see, what was the current year sales? The current year sale was 350. So what we'd have do is just do this: 350, 1, 2, 3, multiplied by our percentage. What was our percentage now? Let's just go check. So I'm gonna check our percentage. We acquired 75,000 out of 300. How much is that? 25%. So 75. So what we'd have done is do that. Multiplied by 75,000 divided by 300, which is 25%. We have done that. But there's no point because you increasing share of associates profits, decreasing share of associates profits. So we don't do the first journal entry. This is only applicable if the associate is selling to the parent. If the parent is selling to the associate, we deal with it how we dealt with it on top. So we don't do this journal entry. There's one highlighted in red, we don't do. I'm just showing you why we don't do it because it does not make sense. You're increasing share of associates profits, decreasing share of associates profits. There's no point. Because remember, we want to decrease the sales of the associate and we want to decrease the cost of sales of the associate. But we can't impact the associate sales and cost of sales. Why? Because we don't bring the associate onto the group books on a line by line basis. When we bring the income statement on the of the associate, we bring it on in the line item called share of associates profits. So therefore, we don't do this journal entry. Okay, I'm just showing you so you understand why we don't do it. But we will do the second journal entry. So the second journal entry
Okay.
is to eliminate closing inventory in the current year balance. So remember, who have the profit? The profit is sitting in the associate's books. So therefore, we have to adjust the income statement of the associate. When you want to adjust the income statement of the associate, you can't adjust it using the actual line item. You adjust it by using the line item called share of associates profits. Who have the inventory? The inventory is sitting in the
Yes.
parents' books. So the parents' inventory from a group perspective is overstated. So therefore, the inventory of the parent from a group perspective need to decrease. Why? We need to eliminate the unrealized profit. So inventory needs to decrease. Inventory is an asset decrease on the credit side. So we're going to credit inventory. Why can we use the line item inventory? Because it's the inventory relating to the parent. We bring on the parent from in the group books. We bring the parent on a line by line basis. Assets, liabilities, income, and expenses. Therefore we can use the term inventory because this inventory relates to the parent's inventory, and the parent's inventory is brought on a line by line basis. So we're gonna decrease inventory. The inventory on hand was 57,000 rand. We don't want to eliminate the full 57,000 rand. We only want to eliminate the intercompany. We only want to eliminate the unrealized portion. The unrealized portion is 20% on sales. Because it's on sales, we divide by 100. If it's on cost, we divide by 120. Okay? Because on sales, we divide by 100. But remember, the full unrealized profit, 100% of unrealized profit is not intercompany. It's only our portion, which is 25%. So therefore, it's going to be equal to 57,000 Rand times the unrealized profit, which is 20 divided by 100. But we don't want to eliminate the full 100% unrealized profit. We only want to eliminate our percentage, which is 25%. For every debit, there must be a credit. We would want to debit cost of sales, but we can't debit cost of sales because the cost of sales relates to the cost of sales of the associate. Remember, we can't impact the associate's line items. So therefore, the income statement line item that relates to an associate is share of
Yes.
associate profits. P&L, SFP.
Yes.
Okay, so we're happy with that.
Yes.
Then we're gonna have for income tax, we can't call it income tax. We can't call it income tax because income tax is from the associate's point of view, so we have to call it share of associates profits. And then here we'll have deferred tax, SFP, BNL. So it's going to equal that times 28%. So the important aspect is that when you're dealing with the associate's income statement, you call it share of associate's profits. When you're dealing with the associate's balance sheet, you call it investment in associate. That's the basic rule. Okay, so that
Okay.
is the first one. Now we're going to deal with the third journal entry. The only reason why we're going to deal with the third journal entry is because there's unrealized profit relating to the prior year. There's unrealized profit relating to the prior year. Okay, so what you must know, the prior year journal entry will simply be if this was an associate, if this was a parent, if this was a parent subsidiary relationship, the journal entry would simply be retained retained earnings, cost of sales, retained earnings, cost of sales, SCE, P&L. So that's the journal entry. This was a parent subsidiary relationship. But what do we know? I'm going to just take the score. Just give me a moment.
Oh, okay.
Faiz, hello. Yes, I'm good at yourself. Yes, I sent you a message. So, so here we have retained earnings. This is the parent subsidiary relationship. Now remember, from an associate, the income statement relates to the associate. So this is we're still going to call it retained earnings. That won't change, but we can't call it cost of sales. Why? It relates to the income statement is from the associate's point of view. So when the income statement relates to the associate's point of view, we call it share of associates' profits. So it will still be the same. And what is it? It was 75,000 Rand. It is 20% unrealized profit multiplied by our percentage, 25%. So we're going to say 75,000 multiplied by 20 divided by 100 multiplied by 25%.
150.
Then we're going to have deferred tax. It will be so it will be share of associates' profits. This is related to their retained earnings. So it will be that multiplied by 28%. So those are the journal entries.
Mm.
So what you can do is you can attempt this again and then try to write up your own notes, your own explanations, and then see if you still understand it. I'll send out this recording now later this afternoon, and then you can maybe watch it again. Okay. You
Okay.
have any questions? So this is the answers to that. Should be the
Oh,
answer.
okay. I wanted to ask based on because I sent you a part portion of my attempt to the assignment, right? So, um, so on the assignment they had, I think was it land revalued, right? So I wanted to ask based on calculations because I first did an analysis of ownership. Um, that when you do the revaluation, is it correct to do to that's the thing. Minus the amount for deferred tax, and then that total amount should be the one that should be used in your analysis of owner's equity. I don't know if I'm making sense.
Um,
So let's say you have an asset, right, which was revalued for 30,000, right? And
yeah.
then you account for the tax portion of that amount or capital gains portions of that amount, right? And then let's say it decreases by 5,000, which puts it in a position of 25,000.
Yes.
So what I'm asking is it correct to say on the analysis of owner's equity to put the 30,000 as it is or to put it as a 25,000 amount?
No, so the analysis of equity, you need to take the difference, the 5,000. It depends when the revaluation was made. Remember, the analysis of equity only takes into account differences between what the group wants and what the pair what the entity has. So let me look at the question. I never got there yet, and then I'll explain it to you. I need to first see the full scenario because there's different aspects I need to look at. You only bring in something into the analysis of equity if there has been a fair value adjustment at acquisition. If there was no fair value adjustment at acquisition, then we don't worry about bringing stuff into the analysis of equity.
Yes, it was at acquisition actually.
And how much was it revalued by 30,000?
Yes,
Okay. Yeah. Then what you'd bring in. So using at acquisition, it was revalued by 30,000, and then at
yes.
year end, it is now 25,000.
So I'm saying at year end. So what I'm asking is it was revalued at 30,000. So I think the original amount was 148,000, and then they said it was revalued to 178,000, which makes it 30,000, right?
Yes. Yes.
So I'm saying to account for the portion of capital gains tax on acquisition.
Yeah. Yeah.
Yeah, that's the question I'm asking. That so on your analysis of owner's equity, right? So would you recognize the amount at 30,000 or at the amount at revaluation less the capital gains tax?
Yeah. Less deferred tax, less capital gains tax. So must be net of tax. So you'll show the 30,000, and then you'll show the tax separately. Or yeah, that's how you'll do it.
Oh, okay.
Okay. Are you happy
Yes.
with that? But I'll,
Yes.
I'll be, I'm marking finish by Monday, and I'll send it to you guys.
Oh, okay then.
Okay. Any other questions?
No, I think if I have any questions, I'll send them through.
Okay, no problem.
That's just
Yeah,
it.
I'll send
Yeah.
you this later. Okay.
Oh, okay.
Okay. Thank you. Bye bye.
Thank you. Bye.